All right. Mastering risk control, taming drawdowns, and quantitative investing. So, this is going to be a brief presentation on drawdowns, what they are, why they matter, and particularly why controlling them matters, and then a just broad strokes overview of some ways that we can go about controlling drawdowns. Before I get into the presentation, at all, mandatory disclaimer. This presentation is for informational and educational purposes only and does not constitute investment, financial, legal, tax, or any other form of advice. Views in this presentation are only the views of myself and do not necessarily reflect Enders Capital or any other employer's position. Enders Capital Management LLC operates under Regulation D, Rule 506C, with investments available only to verified qualified clients via official documents. No warranty on the accuracy, completeness, or suitability of this information is made. Risk control discussions are general, and investing involves significant risk, including loss of principal. Past performance is not indicative of future results, and no guarantee of objectives or loss avoidance is made. Any references to Enders Capital are illustrative and not a solicitation. Please review fund documents before investing and consult qualified advisors for suitability. For more information, you can visit enderscapital.com. All right, who am I? There I am in the right upper corner, and there is my ugly mug shot right there. So my name is Risley Mobile. For the purpose of this presentation, I am the founding partner, COO, and head of research at Enders Capital. But a little bit of background about myself. So I hold a bachelor's degree in chemistry with minors in physics and mathematics. I also hold a medical degree from the University of Iowa 2025. In undergrad, my primary research background is in physics and mathematics. I actually have a physics publication on rectifying misconceptions about special relativity theory. And I currently work as a resident physician. I'm in diagnostic radiology residency. That's enough of my ugly mug. So what are drawdowns? It's worth taking a second to talk about this because I find there's a little bit of confusion about this every once in a while. So on this chart, we've got this green line, and that either represents portfolio value, stock price, whatever you want it to. And then we have a red line there that's our high watermark. And then this is called a drawdown plot because of all this stuff on the bottom showing us how much drawdown we are experiencing. So anytime we make a new all-time high portfolio value, our watermark moves. But whenever we are off of that or have less than that, then we are considered in drawdown. The maximum drawdown is defined as the deviation from the high watermark, peak to trough, before that value recovers and starts making new all-time highs. Being over here is lots and lots of fun. Being over here can be scary, and drawdowns are unavoidable in investing, and we want to talk about why we should work on controlling those drawdowns. Excuse me. So there's a couple of reasons. One of them is it can be really emotionally taxing, and learning to deal with that emotional taxation when it comes to managing money is a skill. It's something you can get better at, but it can affect your decision making and not in a positive way. So that's a great reason to control drawdowns. It's a lot easier to think about the money you're managing when you're in 5% drawdown than it is when you're in 35% drawdown or 50% like in GFC. So we like to control drawdowns for that reason, just for the sake of our cortisol levels. Drawdowns are going to amplify portfolio level volatility, which is going to affect your risk adjusted returns. We talk a lot about Sharpe ratios in this industry, and there's a good reason for it. If I'm experiencing 25, 30, 50% swings in my portfolio value, but I only return 10% a year, I'm not doing a very good job. But if I'm experiencing 5% swings and I still return 10% a year, I'm doing a much better job. So risk adjusted returns matter. And then the other thing about drawdowns that we're going to spend a little bit more time on is that it affects your ability to compound returns. This is something called volatility drag. I want to try and give you a little bit of intuition about volatility drag in the next slide. So let me move my mug over here. So what I did for this graph is I built two portfolios. Portfolio A is our low drawdown portfolio, and then portfolio B is our high drawdown. The way I did this is Portfolio A has an annual standard deviation of 10%. Portfolio B has an annual standard deviation of 20%. And then I ran a Monte Carlo simulation on both of those. If you don't know what that is, it introduces some randomness and runs like 1,000 iterations to get me an idea of when there's some randomness involved, what's the difference in these portfolios going to be. You can see at the beginning here, our portfolio A is the blue line and B is the orange. So you can see we've got a little bit of outperformance from portfolio B early on, but then once portfolio A gets ahead, it really just starts charging ahead. Now I left something out that's important about both of these. They both annualize 10% a year. So why is portfolio A outperforming portfolio B? Well, the reason is because of volatility drag. So let me give you a math example here. I apologize, but I will keep it simple. So let's say we started with a portfolio value of $100 and we lose 30%. We're in 30% drawdown. Then how much do I have? Well, it should be pretty easy. It's just $70. But how much do I need to make to get back to $100? Do I just need to make 30%? Well, the answer is no. 30% of $70 is not $30. You actually need to make about 43% to get back to that high water mark of $100. That's ultimately what's going on here is some of the returns in B are going to recovering from this, and we're losing that compounding ability of our money. If you can get away with missing some drawdowns, then all of that work that's going into recovering from drawdowns in portfolio B can go into making new all-time high portfolio values on portfolio A. So this is a big deal. The final return over a 10-year simulation here with an annual return of 10% is 148% for portfolio A. You can see that here. And then portfolio B is 131%. So about a 17-ish% difference between the two over the course of 10 years. 17% is a lot. So this is a big deal, particularly in algorithmic trading. So key takeaways: if your portfolio drops 30%, you need to make back 43% to get back to the high water mark. If you don't have the drawdown, then those gains go towards making new all-time high portfolio values, not recovering from drawdown. And another thing that maybe is a little bit more of a nuanced point here, but unchecked drawdowns can kill algorithmic strategies pretty quickly. If you have a strategy that turns 10 to 15% annualized return, but it's really high volatility, this volatility drag can turn that algorithm into something that is either flat or even negative in terms of long-term performance. So that's another really good reason as a quantitative fund for us to control our drawdowns. So let's move into the next portion of this. We're going to just broad strokes talk about some strategies for risk control. I'll move my face down here. What's up? So this one you've heard about a lot, diversification. Now, everyone talks about this. I think that I have a pretty strong argument that very few people do this well, but I'm not going to expound on that opinion here. But ultimately, what diversification means is that you are invested in either uncorrelated strategies, uncorrelated return streams, or uncorrelated assets that all have positive performance. And this is described as like the only free lunch in investing. And that is correct. You know, from a drawdown standpoint and an ability to compound your money, diversification is unbelievably important. This probably deserves its own standalone video to talk through a little bit of the math that's going on here. So I won't try and do that here without examples. We'll come back to this, but this is really, really super important. And this is a core tenet of what we do at Enders Capital when it comes to building strategies, modeling strategies, testing strategies. You know, when we move to the kind of pseudo live phase with smaller allocations, one of the things that is the most important to me is the correlation during drawdown of the strategies that we're employing. And ultimately that allows you to reduce your risk significantly. I'll probably make a standalone video about this to try and make this point a little bit better. Another strategy for risk control, stop losses, which I'm sure we've all heard of. There's a lot of different ways to do stop losses. You can have trailing stop losses to varying degrees. They can be static. You can move them systematically. You can just have them straight up trail. They can be dynamic, which is kind of, I would say more people are doing this now, but you can have dynamic stop losses that move based on the volatility of the asset. You can do this with just like ATR multiples. And then in the retail world, in my experience, most of the time stop losses are discretionary, which I will hold my tongue about. Inverse Capital does have a discretionary override for very abnormal market situations. If we are, high beta to the long side, and something really bad, some sort of headline or something happens, and we think it's going to get worse, we can discretionarily override what's going on. That being said, we're talking about things that are like 1 in a million sort of things. Not quite someone getting nuked, but something close to that. We really stick to our systematic position management. Jim Simmons has a really famous quote that we never override the computers because you can't model that. You cannot model your discretionary decision making. So we have not to date hit the big red button, as I like to call it, but we have that ability to. And as money managers, our goal is to not only preserve our clients' money, but to make them money. So if we feel like it is necessary, we will absolutely do that. But generally speaking, we have a systematic position management approach that decides when is it time to move into or out of a position, and it does that technically and takes the emotion away from us. There have been plenty of times where emotionally I thought we were in the wrong position as a portfolio and was proven wrong, but the computer doesn't care. It doesn't have emotions. It just takes the position. So stop losses can be useful. Hedging, a lot of times when I say hedging, people jump to options. They think that's what's happening. Options are definitely a way, but there's lots of other ways. Large institutions a lot of times will use a lot more futures positioning, particularly on the indices, because the liquidity is so high in the futures market on the indices, like the NASDAQ and the SPOOs. But ultimately the smarter way to do this is to have a systematic approach to put hedges on for things. You can use inverse ETFs, options, futures. You can take exposure to volatility products, which is one of my personal favorites and something that we do at Inverse Capital. But I think the key thing here is that it's a systematic approach to put on hedges. We don't put them on based on our feelings about a headline or anything else. Discretionary approach is common for non-hedge fund money managers ahead of impactful data, large news events, or even gradually exposing discretionarily to hedges as you have a good year, which I could probably talk for 45 minutes about why that's a terrible idea, but again, I will save that discussion for another day. Inverse Capital does have a systematic approach for moving both into and out of any beta neutral or negative beta positioning. We don't use options and we don't use futures at this time. That is something that is coming for us in the future. But we do achieve negative beta in other ways, whether that be via inverse ETFs or volatility products. I particularly like volatility products because of the convexity that you can get out of those a lot of times, when especially if you have any idea how to tell if it's mispriced. So we do a little bit of that, and ultimately that's helped us keep our max drawdown. So in 2025, now that the year's closed out, our max drawdown was less than 8%, and the S&P's max drawdown was greater than 20%. That's a big difference, less than half of the drawdown of the S&P. So we're pretty happy about that. So that's just like 3 big picture things to do or to think about or develop strategies around to help you control your drawdowns. Ultimately, probably the most important part of this is to monitor and adapt those strategies that you use to ensure that you are still protecting yourself from drawdown. A great example of this is, a lot of assets are air quotes uncorrelated most of the time, but when you really care about it, they are not uncorrelated. And a good example is equities and bonds in the U.S. market. If you go back and look at historically scary times like 2008, if you had a 60-40 portfolio, not only did you miss out on subsequent upside in technology, but you were not in any way protected from the downside in 2008. And that 60-40 really hasn't been good since the 80s. But that's one of the things that you have to be very aware of is correlation tends to spike in times of fear. So a lot of correlations go through the roof whenever everybody gets scared. We saw a lot of that in April of 2025. So you have to be paying attention to that data. You also have to do your research historically to have an idea of what's going to happen when people get fearful to some of these correlations. And probably have some sort of circuit breaker to protect your money is not a bad idea. Algorithms are adaptive. It can be machine learning or human learning. At Enders Capital, we do both of those things. Our strategies are constantly getting tweaked. To zoom out a little bit, that happens for a couple of reasons. One of them is that edge just bleeds over time. But the other is that we're always learning new things or seeing new trends or shifts. And as the market changes, okay, so a really easy example. Okay, so since 2020, you could develop a very basic NVIDIA dip buying algorithm and make a lot of money, right? Of course. Why wouldn't you do that? Well, that's not going to last forever. This up and to the right thing does go on for a long time, and usually a lot longer than people think it should, which is why it's so hard to be bearish and make money. But it will not go on for eternity. We will have a bear market cycle, and you need to ensure that you have robust models that are also going to make you money in those time periods. Regime shifts and other things are something you have to keep an eye on, and that may help you decide to adjust your allocations between different strategies that you run over time. So monitoring and adaptation is really, really important. This graph here is just here for illustrative purposes. So we launched in March of 2025. So you can see March and April, the first two ticks there. We're missing what was about an 18% apples to apples drawdown in the S&P based on our start date. But you can see that SPY was negative for the first 2 months there, and we were positive. We were flat for the first and positive for the second. Our largest monthly closing basis drawdown to date is 0.8%, which we are really, really happy about. Now, when you get more granular and you look at intra-month, we have more drawdown than that. I think our max in April was maybe 7.2% or something. Don't hold me to that, but it's definitely less than 8% max drawdown on a daily basis, which is really speaks to the importance of some of the things I talked about before, because we really hammer those home in the way that we construct our portfolio and when we decide what strategies we're going to run. So key takeaways, discipline over emotion. If you're going to get into quantitative investing, then you have to trust your model. Ultimately this is a statistics and math driven game that you're playing. When you deviate from that and you decide to start making discretionary decisions and interventions and emotion gets involved, then things can go bad. If you got emotional in April, then you probably sold the bottom like a lot of people did. And you are part of the reason the bull market is continuing, because you are now having to chase, because what else are you going to do when equities go up and to the right? So stick to the model, let it do its thing. When you're thinking about the, algorithmic strategies work on anything. You might trade corn futures algorithmically, but be rigorous in the principles that you employ within your models, especially from a risk management standpoint. Risk management is the most important thing. And just a reminder, low drawdowns equal sustainable alpha. Let's connect if we're not already. I'm not sure where you're seeing this at, YouTube, LinkedIn, whatever. But there's a little bit of my information there. So enderscapital.com. You can get more information about us if you want to. You're welcome to shoot me an email with any questions or requests for more things to chat about. It is just risley@enderscapital.com. There's my QR code for LinkedIn if you want to hit me up there. If you have any questions, feel free. Otherwise, I will see you in the next one. Peace.